All right, everyone, here we are with ticker symbol CTRM, Castor Maritime Inc. And before we jump into this chart, I want to say welcome to all the first-time viewers and investors. Welcome to the channel, Invest for Tomorrow. To all the subscribers, welcome back. And as we dive into all the information we're going to go over, I do want every single investor and viewer to be aware that we're going to talk about the S&P 500 index, how it rose up today, why it rose up towards the end of this video. We're going to update on the 10-year treasury and how it's been going up even though the market went up. So what to expect moving forward in the next coming days and weeks. And if you guys want to know what ticker symbols I'm watching and adding to my watch list and letting everyone know to add to their watch list, and you want live updates, the weekly stocks I'm watching, you can join me on over at the Patreon. The link is down below. Now, if you don't feel ready right now because the market's a little rocky, I do want you guys to be aware as things start to recover, you're definitely going to want to know what ticker symbols it is that I'm watching, adding to my watch list, and weekly, I'm always looking for opportunities. So you guys will be able to be a part of that whenever you're ready. The link is down below in the description. So here we are with CTRM, Castor Maritime Inc. It dipped through support, right, of 74 cents, hit newer lows, and now it started to recover. So let's see our new support and resistance based off the chart. But I do want every single investor and viewer to be aware that the overall market reacted like this, and it showed us how low it could go. I mean, that's the lowest point we've seen CTRM break, and it was actually supposed to hold itself up above 85 cents and also above $1. It's broken through those two supports, and we certainly have seen it hit newer lows, and now it's fighting to get back up. So the support level here is 65 cents. If that gets broken through, I mean, we are definitely going to see newer lows, and this could start to fall pretty quickly and rapidly in the downward direction. I do want every single investor and viewer to be aware of that. Now, the 50-day moving average is 82.54 to be exact. I just round that up to 82.50 or 82.60 if you would like, but at the end of the day, the 82 cent range is super important, and resistance is not that far from it to the hundreds and thousands place. But let's go ahead and see here what our support has to become, right? So this is our resistance that needs to become into a support, and that's 82.95. That's what the bulls truly need to break through, because they're not that far from the 50-day moving average. We are in tug-of-war zone, and this is what we need to become a support so that the bulls can pull upwards to newer highs and new resistance levels, and then reach 85 cents and some change, and then up here at 92 cents, and then start to work their way back up to $1. But before getting anywhere higher, 82.95 needs to be broken through, turn into a support so that the bulls can pull up to newer highs and new resistance levels. Now, since this is such a broad stretch between the resistance, the 50-day moving average, the closing price, and the support, I would use this point right here as a midway point, and that's 74.94, or if you want to round it up, 75 cents, to see how the stock is reacting and where the momentum is going, and see if the bears are tearing this one down or are the bulls trying to bring this one back up. As always, if you found this video helpful and informative, please do so and subscribe. Don't forget to click on the bell to turn on all notifications and not miss a single video that I post. Share this with your friends and community, and don't forget to hit the like button to let me know you watch this video. Stay tuned to the very end because we have a lot to cover, and I won't want any of you guys to miss out on it. We're going to cover about the S&P 500 index. We're going to look at an article talking about what made this run go up, how the S&P 500 index and the other indexes are doing, and the 10-year treasury bond. So stay tuned for all this information. So we have a lot to cover here, and we have the S&P 500 index here in front of us, and what I want us to be aware of is the fact that, yeah, today there was a run. We need to see if this run can hold itself up, and how quickly is it going to actually eradicate itself. Because when I look at the chart, I look at it this way. What do I see, and what is it showing me, and what is it that the chart is sending a message to me about? So the first thing is, I've been looking at the peaks, and every time we hit these peaks, right, we go ahead and dip harder. Now, a lot of investors say that 10% to maybe almost 15% is a correction. 15 to 20 is starting to get closer to a crash, and 20 and beyond, we certainly have hit the crash territory. Now, one thing I do want us to be aware of is we almost hit 4,000. We hit 3,950. So I would go ahead and just round this up to 4,000, and 10% of 4,000 is 400. We are only around 250 right now. Even though we've been going down and up, down and up, down and up, we're still at 250. So I still see room here if we are in the midst of a correction, right? We need to see. Now, the reason why this ran up, which we see here in our articles, is the fact that dip buyers fuel stock rebounds. So that's the first thing. There are people buying the dip, right? Retail investors, institutional investors, and so forth. Now, the second thing I saw was the fact that there was a rise because of the solid jobs report. I've said this in my other video that I posted. I'm really glad to see this because this is showing not just economic growth or anything like that, or possibilities of an economic growth, but our population, right? Our country as a whole. Jobs reports are looking pretty solid, or a little bit better than expected. It's not all about the market. It's not all about us making gains. It's also about our country and our people. So that's cool. Then we also have massive fiscal stimulus and vaccination drives. Those are the two other things driving the market right now, which could be the fiscal stimulus could be a temporary run. Vaccination drives could be temporary as well, just for a few weeks or months. So that's something we need to think about as well. And then we have here our 10-year treasury. So when we go to the 5-day, you could see it here. It's at 1.55. Watch, it's going to spike up. And this is what the article was saying as well. Watch, it only took a few minutes. There you go. There's the jump. So what it was also saying here was, yeah, the dip buyers fuel the stock rebound and treasury stays steady. So when we look at the treasury, right, on the 1 day, it was pretty steady. It was kind of going downwards and hanging out sideways until the last couple hours of the day, which we're going to look at right now. Just pay close attention. There you go. There's the spike. 1.5770 right now. And then we put the 1 month, it's going to spike up higher. So when we look at this, we've been going higher and higher, and this is not going to show its effects yet, probably for the next few days or weeks, or we might see it as early as Monday starting to affect the market if it stays around these levels or actually goes higher. And then the S&P 500 index is going to do what? It's going to actually start to go in the downward direction again. And yes, these jumps here are holding up the market from going in a straight arrow down. But the fact of the matter is that we continue to go in that same direction. And that's what we want to watch for. That's what we need to look for. And that's what we need to be careful about here and not get too excited. Now, if we see some consolidation for a few days or a week, then it's probably something showing strength and saying, hey, this might have been the bottom, and every single dip buyer that fueled up the stock rebound was onto something. But right now, I'd rather be a little bit more hesitant and miss out on catching the dip or catching it rebounding from the dip, and just kind of watch and see if it hangs out in the same area before making any decisions. Now, I do want every single investor and viewer to be aware that if you're a first-time investor or a beginning investor, these type of corrections and crash, they tend to happen in the market. I mean, we went through several of them throughout the year last year, back in September, October. We even went through one in June. Now, the thing about these corrections, quote unquote, that are healthy is because of the fact that when these corrections happen, it allows for bull markets to begin or actually start to stir up to go to newer levels. Now, every single investor before the 2020 market crash had to have diamond hands. That's where that saying comes from, or strong willpower to not sell and quickly, get out, unless, you've been investing since way back here, since 08, and you thought you were going to eradicate all your gains, and you took a small hit there, because from 08 to there, that, everyone's investment mostly would have probably multiplied, anywhere from 3 to 5x on the low end, and on the high end, 5 to 10x or more. So that's probably someone that went ahead and got out. But anyone that was investing here in 2018 and felt that correction and then started to ride that bull run, and then here in 2020 panicked, they learned the behavior. It takes a few years to learn the behavior. So anyone that got in after this dip and you're feeling a little bit worried about this dip, this is where you're supposed to learn, and you're also supposed to think about the stocks that you're in Do you understand them? And do you see yourself holding them more than a month, more than 6 months, and more than a year? It's very important to understand that about the market. You could do speculative plays. You could do penny stocks if you want to. That's not financial advice. I'm not telling you guys to buy, sell, or hold any type of stock. That's an opinion if you want to go ahead and do that. But you need to have a portfolio as well that gives you a foundational ground to understand what your goal is as an investor long term. So these pullbacks, the one we're going through right now, if you feel like it's a big thing, don't worry about it compared to the long run. I mean, look how many times we've been through small corrections or even a crash, right? Like the one we saw in 2020. So any new investor or beginning investor, this is where you're supposed to learn and not run, okay? Because if you ran back in 2008, you would have missed this run. If you would have ran back in 2015 in that dip, you would have missed this run. If you ran in 2018, you would have missed the run from 2019 all the way up to 2020. And if you would have ran from 2020, you would have missed the dip from here to 2021. And I will be saying a story in 2022, 2023, 2024. If you ran from the dip in 2021, you would have missed the bull run for all these last several years. So definitely that's a message to every learning investor, beginning investor, and even experienced investors that are being a little bit hesitant or being discouraged by the market's movement. This is normal behavior. It's part of the market, but this is why you need to know what stocks you're in and which ones give you the conviction to stay. And this is where you're supposed to get the opportunity to go ahead and load up on more shares the more you can. Now, let's talk about the tweet of the day. So the tweet of the day was, what two catalysts so far in the last week have made the stock market reach these lows we have seen? Do you believe the market will have a slight jump tomorrow or continue its trajectory, how you were supposed to go ahead and pronounce it and write it, but I went ahead and put trajectory and the word tragic in front of Tory. So everyone's looking at it as a tragic pullback. This is not so far anywhere near a crash. We're in a correction. And the two catalysts that have happened so far, and thank you for the one person that went ahead and commented how they felt and what they were stating. But the two catalysts that have happened so far is the fact that the treasury bonds, right, the 10-year treasury and all the other ones, they spiked up pretty fast. And then also the date that Jerome Powell came to speak and try to ease things off, and it did the opposite. But today we're seeing the effects. I guess everyone slept on it and they took advantage of the dip and they bought more shares, and the S&P 500 ran up a little bit. But I do want every single investor and viewer to be aware that we need to watch this carefully. We do, and there is room here if we're in the midst of a correction for it to pull back a little bit more. So what do we do now? Well, my best advice is to pay close attention to the market. Start looking for stocks that you want to learn about or you once wanted and invested in, but it was so overpriced and now it's looking like an opportunity. A stock that was probably at $50 and it's at $20. A stock that was at $30 and it's at $20 or $15, and you have a conviction that it could grow. Look into those stocks. Do your research. This is the time to do research and have all the time in the world to not fear of missing out. And that's one of the best things about pullbacks. Now, hopefully we're not in a crash and we're in a correction, but prepare yourselves. Be prepared and aware. As always, guys, thank you guys so much for watching, and let's make some money.